High interest rates often get a bad reputation, and it's easy to understand why. When you check your mortgage, look at your car loan, or glance at a credit card bill, the numbers feel higher and everything seems more expensive. But high rates are not simply a burden. They are a signal. They indicate shifts in economic incentives and create opportunities for people who understand the landscape. Recognizing these signals is the first step in navigating the financial environment effectively and even benefiting from it. High rates change the rules of the financial game. When rates are low, borrowing is cheap, and the system rewards spending, taking risks, and moving capital quickly. In high-rate environments, borrowing becomes costly, but other strategies become more profitable. Saving, patience, selective investment, and disciplined financial decision-making all gain value. Knowing which strategies are rewarded allows you to adapt instead of reacting blindly. Let's start by looking at banks, the most obvious beneficiaries of high rates. Banks earn money from the difference between what they charge on loans and what they pay depositors, known as the interest spread. When interest rates rise, loan rates for mortgages, personal loans, and credit cards increase quickly. Deposit rates, on the other hand, adjust more slowly. This widening gap generates significant additional profit for banks. But the key insight is not only that banks profit, it's that holding cash strategically becomes more valuable. High rates make liquidity a resource that can be deployed in ways that were less effective in low-rate environments. Conservative investors are another group that benefits clearly from high interest rates. For many years, safe investments offered almost no real return. Savings accounts, CDs, and government bonds were not competitive with inflation. Today, high rates have changed that dynamic. Treasury bills, money market funds, and short-term bonds offer meaningful returns without high risk. This allows investors to earn real gains while waiting for opportunities in other areas. The environment rewards patience, not speed, and gives time for careful, informed decision-making. High rates also impact markets more broadly. When borrowing costs rise, prices in some sectors tend to slow or even decline temporarily. Real estate, certain stocks, and private business investments may stabilize or become more accessible. This creates opportunities for investors who are prepared, disciplined, and willing to analyze market fundamentals carefully. High-rate interest rates act as a filter, rewarding efficiency, skill, and strategic planning while reducing speculation and hype-driven decisions. Debt management becomes critically important in high-rate environments. Poor borrowing decisions can be costly, but reducing or eliminating high-interest debt effectively provides a guaranteed return. For example, paying off a credit card charging 20% interest is equivalent to earning a risk-free 20% return. High rates reward people who manage debt intelligently, strengthen their balance sheets, and position themselves to take advantage of market opportunities. High rates reward people who manage debt intelligently, strengthen their balance sheets, and position themselves to take advantage of market opportunities. Poor borrowing decisions can be costly, but reducing or eliminating high-interest debt effectively provides a guaranteed return. For example, paying off a credit card charging 20% interest is equivalent to earning a risk-free 20% return. High rates reward people who manage debt intelligently, strengthen their balance sheets, and position themselves to take advantage of market opportunities. Skill building and personal growth are increasingly valuable in high-rate periods. When money is easy to borrow, mistakes are often tolerated and poor decisions can sometimes be covered by cheap credit. In contrast, high rates create an environment where capital is more selective. Businesses, investors, and individuals are rewarded for efficiency, knowledge, and long-term planning. This makes developing skills, increasing earning potential, and building consistent income streams more important than ever. The economic environment shifts in a way that emphasizes preparation over luck and discipline over speed. High rates also influence corporate and government behavior. Companies focus more on profitability and efficiency when the cost of capital rises. Startups that rely heavily on borrowing face more scrutiny, and investors demand stronger fundamentals before committing capital. On a government level, high rates help stabilize inflation, maintain the strength of the currency, and provide predictability. Predictability reduces uncertainty, which is valuable for anyone making strategic financial decisions. Understanding these broader patterns allows individuals to make informed choices and leverage the economic environment to their advantage. Opportunities created by high interest rates are not limited to cash and bonds. When borrowing costs increase, the cost of capital rises for many projects, which can reduce competition and volatility. Assets that were previously overpriced may become accessible at lower prices. For investors with liquidity and patience, this is an opportunity to acquire assets under better conditions, select high-quality investments, and take advantage of temporary market imbalances. High-rate interest rates essentially reward preparation, strategy, and the ability to wait for the right moment. Another key aspect to consider is the impact on long-term planning. High rates reward people who think ahead and make decisions based on understanding trends rather than reacting emotionally. This includes managing cash flows carefully, allocating investments thoughtfully, and avoiding impulsive decisions. For example, instead of rushing into a hot stock or real estate purchase, high-rate periods encourage analyzing the value, timing, and risks involved. Those who adopt their strategies to these conditions gain a significant edge. So, instead of asking who loses when interest rates rise, a more productive question is who benefits and how can I position myself to benefit too? The answer is clear. Strategic cash holdings, conservative investments, disciplined debt management, and skill development are all rewarded. Market opportunities expand for those who wait and analyze. High-rate interest rates do not just punish, they create advantages for the prepared and informed. This is true whether you're managing personal finances, investing, or running a business. High-rate interest rates are not permanent, they are a phase in the economic cycle. Every phase rewards different strategies. The people who do best are not those who complain or wait for luck, but those who understand the environment, recognize patterns, and adjust their actions accordingly. By learning how high rates shape incentives and rewards, you can make decisions that strengthen your financial position, create stability, and take advantage of opportunities that might not be visible in low-rate periods. Viewing high-rate interest rates as a tool rather than an obstacle allows anyone to navigate the economy more effectively and benefit from it.
If this video helped you see high interest rates differently, like it and subscribe. Here at Peak Economics, we focus on understanding the U.S. economy and learning how to navigate it effectively.